quite distinctly different things.
So picking up on something that Danny said in relation to neobanking, that we're overestimating the impact of neobanking. You would say from an Australian perspective, that's probably true. If you look at the US or UK, I think you would make a counter argument. You look at Revolut, Starling, Monzo in the US, you look at Chime and their competitors. We're actually seeing banks or neobanks with multi-billion-dollar valuations. We can talk about the differences in markets. The question is, what is different about Australia versus the UK versus the US, where we see more or greater success in direct-to-consumer neobanks? And what are the lessons that we can take from it for Australia in terms of what's working and not working in the ecosystem?
I'm gonna go with that one because I've thought about this a lot. There's two things I'd point to. One is just the size of the market. The fixed costs of being in banking have been going up because of regulation. And so therefore you need a pretty big customer base to spread those costs against. And in Australia, just the size of the market has made that difficult. And the second thing is the businesses that have done really well have typically been ones that have attacked a large cross subsidy, where there's essentially an excess revenue pool that people can go after. And if you take Revolut as an example, foreign exchange, international foreign exchange fees was definitely one of those pools. In Australia, if you take the payments world, for example, credit card interchange is pretty much the lowest in the world in Australia compared to the rest of the world. So that profit pool opportunity isn't quite there. And I think that those two things would be what I'd point to.
Can I also jump in here, David? I'd also like to say I think it's got to do with product differentiation. So, you know, if you look at our incumbents in market, you know, CBA, NAB, ANZ, Westpac, they all have pretty good digital banking offerings and platforms. And so the need also wasn't there. So until you get the product differentiation pieces like the crypto trading currency in Revolut, or your lounge passes or your foreign exchange, until you get that product differentiation in market, you're probably actually not going to see people move. And we've had 2 years in lockdown, so the traveling and the foreign exchange isn't actually that attractive for someone to move towards these products. But I think we'll see a shift once there's different products in market and different offerings for the neobanks as well.
So is the lesson to take away from Australian fintechs that they need to be looking more at unbundling or monoline products, or is a lesson that global banks need to be looking at Australia banks for how to deliver digital experiences?
It's a bit of both. I mean, I'm pretty biased, but actually Australian mobile banking offerings are among the best in the world. But the flip side of that is it's also, if you can make a business work in Australia, because there's not as much revenue, you're probably going to be very efficient, and therefore you should actually be quite competitive externally.
I mean, I tend to agree with that, right? Which is every market has its own nuances, right? When you look at each market, I think you need to start from first principles in thinking about what's going to work the best. So Brian touched on the cost structure in Australia and sort of the market size, and that's definitely a driver. But also from a product perspective, what you've seen in the US, for example, is a real focus on crypto, right? Like just coming back to crypto. If you look at Square's basically a crypto exchange, right? Most of their revenue is flipping from interchange and the other pieces that come along with, you know, the stocks and whatever else they do now. And the same thing with Robinhood. I think the last quarter, 70% of their revenue was crypto, right? So the point being is less crypto, but the point is really thinking through what is the unique value proposition you can bring to market that's going to create a wedge. And in Australia, what we've basically seen are people trying to do what was done and what has been done. And so you need to open up the aperture in terms of what can be done and what are the next set of opportunities. And I think also that ties into what is the unique wedge you're going to come to market with, right? We talk a lot about embedded fintech. Really what embedded fintech, the proposition is about what can we do around financial services that is native to an experience, right? And so it's implanting financial services at the time, the place where it's most convenient, makes the most sense. I think that's going to be the wedge that we tend to see being the one that's most successful in a market like Australia, because that's right, banks are fairly good here. No surprise, they work. It's opening up the aperture around what could be done that is the key, I think, in Australian market. And that's why we haven't seen a breakout yet. But yeah, anyway, sorry, I've got quite a few views on this one as well, obviously.
And Danny, so you actually put real money into the space through Reinventure. What has been your perspective on whether it's neobanking or just direct-to-consumer fintechs in general in Australia? We can go through the different data and see who's performing and who's not, but from an investor perspective, do you have a bias to or away?
Not particularly. I think it depends entirely upon the product offering and market. I mean, part of the reason we've never invested in neobank is we had two conditions for investing in a direct-to-consumer neobank. And some of that applied similarly to the wealth management space. And those were a fundamentally differentiated cost to acquire model. I mean, if you're competing with the bank, with their embedded branch network and strong brand presence on Google ads and Facebook ads, you were doomed. And secondly, you needed to have a natural right to ask for the salary deposit account. And if you couldn't do that, then you were just a PFM tool. And that proved to be very difficult in this market. And so it was really the unit economics of a lot of those direct consumer models that proved to be fundamentally difficult around that. Similarly with wealth management, direct to consumer wealth management businesses had very, very expensive cost to acquire models. So ultimately, unit economics is a lot of what makes direct to consumer propositions work or not work, which is why things that have either got a 10x product difference or some kind of inherent network effect make a lot more sense because the unit economics work. There's enough money in the industry and kind of the banking proposition, but you've got to have a cheap wedge and then your ability to then move across other products in a seamless way. And if you don't have that, it's going to be a challenging space.
I think, Danny, the other thing that's undiscussed here is I think it's easy to see the CAC side of this, right? Which is what is the cost of acquisition for a customer? And I think a lot of investors get really hung up on that space. Under discussed is actually the cost of running infrastructure in this country. It's really expensive as compared to other markets. Part of that is there's not a lot of choice. If you want to, for example, paying methods, right? Let's think about the classic example of accessing NPP. There are basically 3 players and all of them sit on top of one bank, right? So it's limited the differentiation you can actually build around the cost structure of your business in Australia. And that's actually really challenging. When you're in the weeds and sort of close to the metal, you find that there are really not a lot of options in this country. That's sort of something that probably needs to change. We saw this week Wise is one of the few that can access NPP directly. That's a cost structure differentiator for them. And so in many ways, what we've seen is, yes, CAC is hard to figure out in neobanking, but the harder bit, and what you see in the US, for example, is the cost structures quite different across the different neobanks because there are more players available to provide the back-end services and partnerships that you need to access fundamental payment rails or banking services. That's the issue in Australia, I think, that's under-discussed though.
Can we just put this in perspective of what Alan just said? So the cost of connecting directly to the MPP is about $1 million, and the cost of connecting to the fast payment rails in the UK is about £40,000. So there's a significant cost difference there for the people online.
Does banking as a service become the solution?
Yes, yeah, it does. It's hard to start a banking as a service solution in Australia though, right? That's the problem. The unit economics of starting a banking as a service proposition in Australia are really hard. You fundamentally need a banking partner that you sit on top of, right? So for example, what Westpac is doing could be really interesting. Whether a bank can do banking as a service is a different question. But yes, you need to have direct access. That's the hard bit, because then the cost structure falls dramatically. And that's what you see in the US, for example, with some of the players. They are now moving to thinking about how they are fully licensed themselves with a charter. That's going to dramatically change their cost structure as well. But yeah, banking as a service is a needed piece in the Australian mix for fintech startups. I think controversially though, it's less banking as a service than it is. We need to fix the stored value facility legislation in Australia. Currently, the PPF license just doesn't work, right? And so we need to move to a stored value facility license. I think that'll fundamentally change things, because then you can access NPP, and then you can also have an exchange settlement account, right? Those are the two big hurdles for a lot of fintech startups is direct access, because your cost structure is fundamentally already from day one actually quite challenging.
The thing is, that is really the issue, in the sense that you can either take advantage of the facility because you want to do something else, or you can try and move up the chain and do more of those activities and get licensed. But if you do that, welcome to the banking world, where the regulation, oversight, the costs, and all the rest of it become quite significant. So, I mean, some of this for me is about classic strategy for a business, about where do you see yourself having competitive advantage. And I think the idea of some of these banking as a service models is that actually, when people get into finding out what's involved in actually being a bank, taking deposits, all the rest of it, they usually kind of go, yuck, actually, I don't want to do that. What they want to do is be able to provide a capability to their customers in the service of something else that they're doing. So, and again, I keep coming back to this reality that Australia is a small place, the fixed costs are high, and so how many people are really going to play in this? You know, I think it's kind of limited. And ironically, I mean, I get the point about for a startup, the startup costs are high, but actually the costs of participating in the banking industry have collapsed. I mean, we did 10x when I was at Westpac. And part of it was, okay, there's something happening in banking as a service. Do we want to play or not? Let's play. But the other part of it was, with new technology, with the likes of AWS bringing the cost down of data storage, with new platform and architectures, the cost of delivering technology services in banking is absolutely collapsing. I mean, and it's not just overseas players. There's a company called Nemo that I'm dealing with in one of my other domestic Australian company that I'm dealing with in one of my other startups. And I have to say, when they first told us what it was going to cost to deliver a lending platform, I nearly laughed out loud, because it was less than it probably would have cost us to scope the project at Westpac.
It would have been considerably less. Having scoped projects at big banks and knowing Nemo's pricing structure, I can attest to that. So Brian, you've looked at banking as a service from the other side when you were CEO at Westpac. Does this run the risk for banks of starting to become effectively deposit-taking institutions, completely disintermediated from their customers?
It does if they choose not to compete. And I mean, I guess the way that I thought about this was, some of this is going to happen whether we like it or not. So do we want to be part of this and see where it goes or not? And my view was, yeah, probably we do. Are we enabling it a little faster? Yeah, maybe. But on the other hand, big banks have advantages in terms of, as Danny was saying, brand, the resources to invest in data, and the people, importantly, the people who can take advantage of these things, who can build the new digital experiences. And so our view was, why don't we back ourselves that we can stay competitive? We may not be as quick on some of these things, but a lot of things can be copied. So, you know, my view anyway, and it was in the end, my judgment was that it was better to be involved and to back ourselves to compete where we needed to compete. If you just decide you're going to be a dumb pipe, well, then you're going to get what you deserve.
So Dave, I might just for the sake of a little controversy, throw in an alternative view there. I worked in telco back in the early 2000s when they were going through kind of similar regulatory interventions, competitive interventions around netco, servco, wholesale, retail dynamics. And it was pretty fascinating to me watching, being a customer of Telstra's wholesale network, how they managed that transition to create an incredibly profitable and incredibly valuable wholesale business. And there's a couple of key differences there for me relative to the wholesale banking as a service kind of construct. And the key one was that Telstra still owned scarce assets. So they still owned mobile spectrum, they still owned exchanges, even with NBN, they still owned material scarce assets, which gave them real pricing power. Whereas when I look at a wholesale banking, if I want to compose it down to its simplest level, it is software and an ADI. And there are 140 odd ADIs in Australia, and software is, as Brian pointed out before, is every generation is just getting cheaper and cheaper and cheaper. And so I think one of the risks is that wholesale banking kind of competes in a race to the bottom in a way that wholesale telco did not. So I think that's the one risk that we yet to see play out. If it gets competitive in that dynamic, there isn't much to keep the pricing power up.
Yeah, I think it's the advantage is, I don't disagree with that. Although if all you're doing is offering generic price, that's never going to be very successful. So it's got to be an element of the flexibility of what you can provide and the way you integrate with the client so that they don't really feel like they want to go anywhere else. The other advantage for the banks, though, is the deposits. And so if you can, in the end, in the very long run for banks, he who has the most deposits wins at the end of the day. And so part of this is, how do you protect your deposit base?
Yeah, there's so two threads that I want to follow there. I don't want to lose sight of the end consumer and what it actually means for the consumer that's moved to banking as a service. But picking up on a point you made about, Danny, that it's basically ADI plus software. Really what it is, it's ADI plus software plus software plus software plus software. Because you're going to have somebody that does KYC, you're going to have somebody that does core banking, somebody that does engagement, somebody that does fraud, so on and so forth. Do we think that the future of banking as a service is an all-in-one package, like sort of like what Westpac offers, or what Volt looks like Volt's offering? Or is it a dumb license, whatever core banking you want, plus a whole marketplace of services that you bolt on? Like, I think this is probably going to lead into DeFi if I'm looking into my crystal ball where this question is going to go. But if we just think about it in terms of time horizons, what do people think that the future of banking as a service looks like?
I think all flavors work, right? It just depends how close to the metal you want to be. I personally have a preference always for being close to the metal, so dumb license works for me, right? Because I think the real advantage that you can eke out in terms of being a fintech that sits on top of bare metal is you can build some really interesting solutions, right? So going to Temenos and ripping down a Temenos core banking solution as a fintech, I don't think is going to be a great differentiator. Probably to me is a signal that you're not probably going to be building, right? And so if you look at some of the more successful fintech startups out there, and again, I'll just focus on the cost side of things and also on just raw number of customers, most have been the ones that have taken the big leap and built their own core systems. And yeah, I think there's a piece around how close to the metal you want to be, and it's usually the case that you start maybe with something a little bit more abstracted and then you work your way back down as you scale. But I think there's room for everyone is sort of the point here. It just depends how you want to build and who you are in terms of your core strength as a team accessing the banking as a service product.
I'll offer a view which is built on Clayton Christensen's observations of value chains, which is basically that when value chains don't work very well, then the vertically integrated players win. And when value chains work very, very well, again, this kind of concept of externalities and internalities and the cost associated with those value chains compose into the different layers, if you like. And then value shifts to parts of that stack where there are moats or network effects or other things. So I think banking has been historically characterized by vertical integration of banks building everything soup to nuts. And I think a huge part of the fintech ecosystem is stripping out each one of those horizontal layers, KYC, AML, debt collection, the list goes on and on and on, and providing a materially better service, which is then open to a broader market. So I think we're on an inexorable march towards full composability of the entire financial services stack, which then leads all the way down into the back end of financial services into the crypto domain. And then people will then be able to assemble those components into very niche offerings, and that'll dramatically lower the cost of delivering a whole variety of competitive products. And so I think the composability is a thematic that is just not going to go away.
Part of the complexity of this conversation, I agree with Danny, and that there are businesses which are really about end consumer propositions, where you've got to create some combination of brand and customer experience and value. And then there are, because of technology and because of the legacy systems within the financial system, there are lots of opportunities to do things better. And so it sort of depends on your business, which you're trying to focus on. And I think the fact that you have all these new enablers is great, but in the end, you still have to create some sort of proposition for customers that's compelling enough for them to switch and to pay you. And that's where I think sometimes businesses in this space run out of steam is that they may not have something which is both differentiated and has some element of moat about it, because a lot of product features, even customer experience, is really easy to copy. And you see that with big banks very quickly. When something gets up some momentum, they just say, right, let's go, that works, let's go copy that. And so if you really want a business that's going to last, you've got to find some form of sustainable competitive advantage, or you've just got to get really good at picking off a slice of what's already happening and doing it better. And there's plenty of opportunities for that.
So there's kind of these two opposing forces here. We've got unbundling in some areas and bundling in others. So we've got unbundling in that buy now, pay later. You can get a buy now, pay later for insurance, for the dentist, for utility bills. So we're kind of seeing the unbundling there. Within small business, we're seeing unbundling where you have Brex going after small business credit cards, or here you have Cape or DiviPay, just starting to carve those out. On the other side, we're seeing some significant, what I would call rebundling. A good example would be Square's acquisition of Afterpay, where you have basically one side, the merchant side of the marketplace, now getting bundled with the consumer side of the marketplace. Which of these forces do you think will win out in the end? And let's start on the consumer side. We can move to the business side, the B2B side, because I think they're probably going to be two slightly different answers. So just starting on the consumer side, what do we think will win?
Short answer, consumer side, bundled offerings that give you a great customer experience, I think will win. People want simple, people want a good customer experience that's really simple. That's my short answer. I think in businesses, unbundled, best prices, best offering will win.
So here's a controversy for you. I think the answer is both. In my career in financial services, I've seen since the 80s, bundling and unbundling is a constant ebb and flow. And I don't think it ever really stops. And partly it's because what you find is, on the one, while there are compelling advantages for bundling, for example, you've got convenience, you've got a big installed base you can market to, you can cross-subsidize among things that you're offering. On the other hand, where you really tend to struggle, and I certainly experienced this in my banking career, and I think lots of companies do, is that when you start trying to have the Lord of the apps, the one app to rule them all, what you end up finding is that the user experience, discoverability of capability gets very difficult. And you have a prioritization issue that's a reality within those companies. So you might launch some new feature and it gets a bit of support and marketing buzz about it for a couple of weeks. And then a month later, the company is back to focusing on whatever it is that drives their biggest revenue thing. And it gets starved for resources. It doesn't innovate as fast. It doesn't get the marketing budget. And so you can have a player who can come along with a much more narrow, streamlined customer experience and have that be very compelling. So I don't actually think it's one or the other. I think you end up with a bit of both. And I don't think that'll change. I think it'll continue to kind of ebb and flow. And just to emphasize this one, just for a bit of a laugh, line of credit against credit cards was something we introduced at ANZ in credit cards nearly 18 years ago. And the ability to take a revolving line and turn it into an installment line and pay it off over time. And basically it went nowhere. And the reason it went nowhere was because of the distraction factor, the difficulty of explaining it to people, of embedding it in the digital experience, supporting it ongoing. And I just think that's kind of a reality, that convenience is great on paper, or bundling is great on paper, but over time you can kind of overbundle.
Isn't that an argument that had a fintech come up with that as a product, that they could have successfully then launched that? Because you obviously identified the customer need, and it was more lack of attention that was the death of it. Yeah. I'm just using it as an example of that, the difficulty of, on the one hand, you have great advantages when you've got a broader relationship and you've got technology and you can do all these things. I mean, there are I remember the Westpac stats, the Westpac digital app had well over 100 different features of things you could do in it. But how many of those did you ever use? Well, they're all there, but you got to go find them. It just became really hard to communicate and get people to focus on all the richness that was there. And that's why, it's interesting trading off, from a Beforepay point of view, we have this really nice, clean, great customer experience, become a customer in less than 5 minutes. It does what it says on the tin, bang, you're away, it works.
Or you can embed that in a broader thing, but then it gets a bit complicated. Well, what happens when you're a bank and you don't pay it back and it converts into a different kind of loan, which means you've got to get more disclosure, which means you've got to have more credit approval. It ends up getting sort of complicated. So I don't think it's one or the other. I just think that there's going to be room for both.
And I think the other thing we're narrowly focused on with bundling and unbundling is assuming that the rebundling will look the same as it historically has, right? Which is it all gets bundled into one app. It depends on what your business is and how you want to compose these things together. So for example, the classic example is obviously what we've seen in China with the big platforms there, how they've bundled through really a super app, right? Like a lot of people throw the word around super app. They're not super apps. They're just different services in one app. But the way the Chinese, the big platforms in China have done it is actually being a real platform for these different services and allowing others to embed within their ecosystem and then really make money off the transactions there, right? By controlling the pipes that come in and out of that ecosystem. So I think we just need to open up again, sort of the thinking around what is it that we mean by bundling? Yes, I totally agree with Brian. The ebb and flow between bundling and unbundling will continue for forever and ever, right? There are only two ways to make money, you either bundle or unbundle, right? But it depends on how we think about opening up and thinking, well, what is the art of the possible here versus what is the art of what has been done, right? And so I think there's sort of a nuance around where we go. And again, just comes back to my point. I think we sort of headed to this world where, we sort of discussed a little bit about DeFi. There's a different world, a different way that this can be done. And I think the different world and different way of bundling and unbundling will just open up a different bundle, a different way to bundle. And I think that's more interesting. So I might just transition into a point around buy now, pay later. Yes, everyone can do installment payments, right? The revolving line of credit, it's nothing new. And I think this is where people misunderstand buy now, pay later. It's this idea of it's another way to pay. Yes, there are companies that just provide another way to pay. To my mind, they're not going to make it. Undifferentiated, it's just the same thing. Banks can do it, anyone can do it. It's a feature. Really, what we've seen with success stories like Afterpay, I think is probably the best example of this, is thinking through how do we create two sides of the market so we can actually close the loop? And that's where the power comes from around buy now, pay later. Really, it's a new wedge that creates a loop between consumers and merchants, and being able to control that loop is the real power play here. And that's what I think gets missed. It's actually really interesting when you speak to people from, for example, the US about buy now, pay later. They're like, who cares? Like, it's just another credit card, right? Like, but with 4 installments. And it's like, no, yes, but no, right? The real game here is about owning both sides of the market and being able to close the loop, and eventually, potentially being another payment rail on a closed loop A to A account to account style play, right? And so again, we're talking about buy now, pay later, but I thought I'd just throw that in while we touched on it.
The funny thing about that point, Alan, is that if you go back to the start of the credit cards, the argument for Visa and MasterCard was exactly the argument of what actually has built Afterpay and the other guys, which is going to the merchants and saying, we will help you sell more stuff. And if you accept our credit card, we will help you sell more stuff, and you will sell more stuff. And that's why they were charging 3.5%, 4% merchant service fees to merchants, was on that argument that if you don't accept credit cards, you're not going to sell as much. And so it's kind of ironic that what's happened is the regulators have come in, and particularly in Australia, driven down interchange so far that the banks or the merchant facing organizations haven't been able to effectively mount that case anymore. And so because the buy now, pay laters weren't regulated in the same way with interchange, they were able to come in and essentially re-energize an old argument as to why they should build acceptance.
100%.
So
spot on. Like the genesis of cards is the best story around how this might play out for buy now, pay later. It ended up being a wedge into being a payment rail versus just a acquiring side business, which is sort of where cards have their origin.
The scary thing there is that if it does become that, you'll see the regulators start to intervene because people will start to complain about the cost of payments, which is what happened in credit cards 20 years ago here.
So putting a pin in buy now, pay later just for a moment, and I think what we'll do is we'll contextualize that more in a discussion around marketplaces, because I think that's a really interesting jumping off point for that conversation. One last question on bundling, which I'm curious about, and I think the audience will be. What do we think will deliver the infrastructure for bundling, unbundling, rebundling first? Do we think it will be open banking, or do we think that it will be DeFi? And please back up your thinking on that.
So I'll jump in with open banking, right? So I think let's start with what the conversation around open banking always started with, right? Which was, yes, the data, right? That's fine. But really the question has always been, but when payment initiation, right? When can we start to do payments? That's the big piece that everyone always jumps to with open banking. Data movement, great, really important. Data economy, data is oil, etc. Agree. But where the money is being made is really on payments. And if you look at, I think TrueLay is a really good example of this. Basically, they're turning into a payments company. If you look at the last 3 products, all payments related, right? And so there's this really interesting shift around open banking players realizing that, you know what, we have an opportunity to, again, coming back to this scheme point, be a account-to-account payment rail. And that's the big opportunity, the money-making opportunity, right? The data piece is interesting, it matters, but there has to be something on top of being the pipe that moves data from a bank to a fintech or wherever it goes, right? The thing we've got in Australia that might change that narrative around open banking is that we're obviously going to hit different sectors. Being able to, pull all that data together and do things on top of that data might be interesting. But really where we're headed with the open banking world is really about, it's just a conversation about payments. That's where the big opportunities and the big revenue drivers are going to be. And so if we're thinking about bundling, it's sort of, again, I think it skews the point around what really open banking and where startups are going to head with open banking.
Look, let me broaden that a little bit. I would say that another part of open banking that people talk about quite often is account switching. So the ability to very quickly and seamlessly move from one account to another, which ultimately will lead to unbundling, where you can very quickly embed and swap different kinds of accounts or combine different kinds of accounts within apps. I don't think we've seen it yet, but it's certainly something that's talked about with open banking. And so just back to the question, do we think that'll become a reality, or do we think that when we will really see true composability of different kinds of financial products is going to surpass open banking, and we'll actually have to wait until DeFi can happen at scale?
I mean, tying those two things together, I think open banking is an enabler for bundling. And perhaps the best example of this is we've seen the recent product launches by CBA in energy and telco. And so, in a funny way, a big part of the consumer fintech battle, if you look at Afterpay versus CBA, is a battle for engagement. And it's also a big reason why the banks weren't disrupted by 2 material changes in technology from, analog to web and then web to mobile, is because at each turn, they were able to drive their engagement levels higher through delivery of digital experiences. As that battle plays out for engagement now, it turns out that banks, and potentially Afterpay is the only other one, the most engaged domestic app that Australians have on their phone. And that leaves any other service provider, looking at you energy, looking at you telco, who don't have any digital engagement on their app, probably superannuation is in a similar camp, as being insanely vulnerable to somebody who has engagement and access to data to become the kind of central financial advisory service, or promoting consumption options, which is a hell of an opportunity for an Afterpay whose bread and butter is commerce for people. So I think I think account switching, no one thinks about account switching. They think about the experiences that they're trying to achieve and what's under the hood to enable that. So I think that stuff all fades to background, and open banking becomes an enabler. I think DeFi, on the other hand, creates a hell of an opportunity to unbundle. And I think deposits, that Brian mentioned previously as being the lifeblood of banks, the river of gold in banking, is the single most vulnerable element to be unbundled from a bank. A lot of the neobanks tried it, but none of them could do it economically. None of them could solve the economics. Whereas what's happening in DeFi right now is you can get a deposit equivalent product without the government guarantee. It's all backed by smart contracts and code that can give you a stable coin yield of 4 to 6%, competing with a bank that's offering 0.15%. That kind of delta is phenomenal. And I think when you get a fintech wrapper or a bank-like experience on top of a DeFi backend, we're going to see some material shifts in the competitive dynamic. And we saw an example of the shot over the bow of this in the last couple of weeks, where the SEC said they would sue Coinbase if they launched their lend product, which kind of tells you just how big a deal they think that unbundling opportunity is.
Yeah, I agree with a lot of that. I think this point about DeFi lending, though, I mean, some of this, one way to think about it is that how do you generate a return of 4 to 6%? You do it by making riskier loans. And, you know, in a sense, one way to think about it, I know this is a bit clumsy, but it's essentially a digitization of commercial finance. You know, that's kind of the same argument as to why you should put your money into a finance company deposit as opposed to a bank deposit, because they're using the money to lend for car loans or higher risk retail residential mortgage loans, whatever, which is all great until the day it isn't. And so I could definitely see it growing quite significantly as a consequence of this. But I think part of the regulatory concern that's going on there is not so much, oh gosh, are we going to lose our control over systems? It's actually, this is introducing a new level of speculation and risk into the financial system that we're not comfortable with. And, you know, I just, I don't quite know what to do with that. It's just, I've been trying to get my head around how do the economics of this work. It's not all because of the cost structure of banks. I accept that there's part of that. But it's also exposing people to a new level of risk.
So I don't think that's a fair framing, Brian, because the way that the DeFi lending protocols work is that they're all fully collateralized loans backed by security that are managed and locked up in smart contracts with auto liquidation on any price movement. And
sure,
so the actual
what are the price movements on the backing security? You know,
yeah,
I mean, in the end, you know, where is this money actually going? It's going to people who are speculating in digital currency. A lot of it.
They are borrowing that money to invest in a range of things, but the point is that the lender is not exposed to the
provided
risk
the collateral holds its value. But even
if it doesn't, there's been $25 billion worth of value go through the Aave compound in market fluctuations and volatility of 30-40%, and it's held without any counterparty loss. I mean, this is the point. This is all managed by code. It doesn't need bankers sitting in the middle of it making a decision whether an enterprise or a person is a good credit risk, because it's fully collateralized and managed by technology.
I get that, but you're still reliant on the value of the security. And you know that, and we've seen in financial services over the years that that's not always as secure as you think. I'm not saying it's not going to happen for a while. I'm just saying longer term, I think there are more risks and volatility in some of this than people fully appreciate. If it's going to achieve the potential that if it starts to get to the scale of what you think it might get to, I think that starts to introduce a lot of different risks, because it only works to scale up if you have that same level of people kind of willing to pay those sort of rates.
Yeah, so well, I don't think talking about. Go ahead, Danny. Go ahead, Danny.
I was going to say, I don't think 4 to 6% is sustainable forever. But the distinction that I think is permanently undeniable is the cost structure differential, where some of these protocols are fully automated with no people in the middle, mean that the NIM world that crypto can live on is totally different and undeniably different to the banking structure. So I would say that these people who can't borrow in any other domain are bootstrapping a very attractive deposit equivalent product managed by technological risk rather than kind of government backing and fractionalized banking systems. And I think as that matures, you're going to see something that is fiercely competitive.
And so just tying this back to where this conversation started, Danny, you were talking about the Coinbase stuff with the SEC. What you guys are arguing about really is systemic risk, and what level of systemic risk is it's actually introducing into the overall ecosystem. Beck and Alan, you guys have both dealt pretty extensively, and Brian, I imagine you have too, with regulators talking about these kinds of things. What is your guys' perspectives on regulatory maturity? We can talk about Australia if you want, because you have more experience. Regulatory maturity and understanding in this area. And what that portends for the future of centralization in the government actually being able to manage this risk effectively versus kind of complete decentralization, where the government effectively gets removed from the ability to manage the flows of financial assets.
Just quickly on this one, I think it's a major topic of conversation at the moment is the regulation of cryptocurrency or DeFi in the country. It's obviously a topic of Senator Bragg's latest inquiry. It's well known that a lot of cryptocurrency or exchanges are actually going offshore for the lack of regulatory certainty. So what it's looking like is that there will be an Australian markets license version for cryptocurrency or crypto tokens and exchanges going forward. I think I'll leave it to Danny and Alan to put in their insights in how that looks in the future. But I think from a regulatory perspective, it's a huge topic. And I think the regulators don't have the understanding they need to create the right regulatory framework at the moment.
Yeah, I agree. I think we're still in a phase where regulators are trying to catch up with what is actually happening in the market and get a better understanding of it. That there's no doubt about that, and that's on a global basis. I think the other piece here is just trying to figure out what makes sense to regulate and what actually should be a market function that is fine to operate without intervention. And there's a fine line, right? Like the constant battle cry from startups is we just want clarity. And that's sort of where I think most regulators are working towards, and governments, but it's still complex. Laws meant to move slowly. That's a feature, not a bug. And so I think we're just starting to see the movement in terms of understanding, and then towards reasonable regulation. I think the US is sort of an interesting edge case around this stuff. It's sort of a bit, Danny sort of pointed out some of the stuff that's been happening there. It's a lot of FUD, and it's just not probably constructive for their industry at the moment. So understanding is still lacking, I think, broadly globally, but it's on the way. And Australia's pretty good. Like I use this example all the time. Many years ago, when the ATO came out with rulings around tax treatment for cryptocurrencies, they came out with 5 rulings, and all actually really well written, thoughtful rulings around treatment. Obviously, gaps. I don't personally didn't agree with all of them, but as compared to, for example, their US counterpart, who came out with a 1-pager, right? So there's thoughtfulness in Australia around this kind of stuff, but it's a developing space. It's complex. Regulators are regulators. They're going to regulate, right?
My observation is that they are really hardworking and thoughtful, the regulators here in Australia on this stuff, and are really keen to take it seriously. The piece I would add in, which might sound like an obvious statement though, is that in the end, governments win. And I think that's one of the things where there's a level of debate and excitement in the whole crypto world about going offshore and the rest. My observation is governments win. They have the ability to tax, they have police forces, and they have armies. And in the end, they're not going to allow payments to completely go separate, or the inability to track money. I mean, you look at money laundering concerns that governments have. That means they're going to be very motivated to keep track of flows of money and are going to resist. And we've seen obviously China make its ruling on Bitcoin recently, which I think is a perfect example of that. So, I just think people have to be realistic that you can do things for a period of time where obviously these are new concepts and they can extend in new ways. But in the end, if these things get big, governments are going to regulate them.
So the only thing I'd add to that, particularly on the China piece, that was the 6th time that China has banned crypto. They only had to ban Facebook and Google once for it to be effective. And I think it demonstrates the benefits and challenges of decentralization. Is that it's incredible. I mean, the internet was built to withstand a nuclear war, and I think that the core architecture of crypto makes it incredibly resilient. What I would say is not all governments have the same incentive. China, of course, would ban crypto because if China was a company, its product would be currency. And so they can't stand competition for their primary product and managing that system. I'd say that the US is in an interesting dilemma given they've been the global reserve currency for so long. But you've seen, you've seen with El Salvador, it doesn't have its own currency. It has the US dollar as its currency. had an incentive to adopt Bitcoin as legal tender. And so I think that, like most disruption, it tends to come from the bottom up. I think that you might see that not all governments feel the same, and gradual adoption for reasons for some smaller countries to do better out of a new system might be the thing that changes over a longer period of time the global approach to some of this stuff.
Yeah, I think the El Salvador one is interesting because I've often thought that small countries who don't have the wherewithal politically or whatever proper central bank, that is one of the few genuinely legitimate uses of Bitcoin. Just to put it in perspective, the GDP of El Salvador is 2% the size of New South Wales. So, the likelihood of, this turning into so there's opportunities in this stuff. I just don't think necessarily the world's going to change that dramatically on this. The interesting thing would be, however, if you did come up with a digital version of the US dollar that that people decided to use, that could be quite compelling.
All right, we are rapidly approaching 3 o'clock. This has been heaps of fun. We're going to start with one downer question, then we'll finish on a high note. And let's try to get through these quickly. What do you guys think will be the cause of the next global financial crisis?
Greed.
Can you be any more specific?
Well,
I think that was the cause of.
I think that's been the cause of all of them, hasn't it? So it's likely that it will happen again. Humans are humans.
A major sovereign crisis would be the thing that I think would be most concerning.
Anyone else want to take a stab at it?
Yeah, I think Danny's comment is probably the most apt. Like, it's generally going to be some form of greed somewhere in the financial system, and then combined with some kind of systemic oversight being missed in terms of whether it's a regulator or not. But yeah.
Well, I'm just noting that a pandemic didn't cause the GFC, which is interesting, but maybe the next war will.
Interesting. Okay, what's going to be the next or the first $1 trillion fintech?
Well, it's not technically a company, but I would say Ethereum. It did $1 billion of revenue last month. If you want me to go with the traditional company, my guess would be Stripe.
Any other bets out there?
Yeah, I'm sort of in the Danny camp of, I think it's going to be a protocol. That again, yeah, sure. At the L1 level, Ethereum is just on a tear. Like, everything interesting is being built currently at an L1 level on Ethereum. But I think there are a whole bunch of platforms that sit on top of Ethereum that are going to do exceptionally well. And we could have multiple $1 trillion companies. We've sort of touched on a few. I think a lot of the lending protocols, a lot of the AMMs are going to be huge, just mind-bogglingly large. We're already seeing how big, for example, Uniswap and Sushi have gotten in terms of volumes. I think another interesting stat, just to come back into sort of this DeFi and NFT world, is OpenSea did more in GMV than I think Etsy last month, right? And so there's already huge companies being built. They're just slightly different in terms of their composition and how we might look at, for example, their revenues and how they're actually being derived. They're very different to what traditional fintech would look like.
I'm going to show my age and say it's difficult for me to get my head around that. The entire market cap of JP Morgan is under 500 billion.
I'm going to throw out that the next wave will show who are the haves and the have-nots, and we're going to see a really interesting distinction between the people that are left behind and those that are not.
Sorry. Well, we are bang on 3 o'clock. So first and foremost, I want to say a huge thank you to our panelists. That was an awesome discussion. We probably covered about 10% of what I was planning on covering, which is pretty unsurprising. I'm sure we could do another 10 of these and wouldn't cover everything. Apologies to those to everyone, because I didn't get to ask your questions. In my defense, I'll say this is a little bit like riding a bull in rodeo. So I'm a lot more focused on what's right in front of me than what's coming in from the audience, but maybe we can find another way that we can do this where we can get some audience questions beforehand. Anyway, thank you very much to Fintech Australia for hosting. I hope that everybody enjoyed it as much as I did. That was really interesting. And everybody have a lovely afternoon. Take care, everyone. Bye-bye.
Thank you.